Welcome to the first video review for Chapter 21. Let's begin with loss from a rental activity. California conforms to the federal exception that allows a taxpayer who actively participates in the management of their own rental real estate to deduct up to $25,000 of passive loss. If the filing status is married RDP filing separately, this amount is reduced to $12,500. California also conforms to the phase-out of the allowable loss for modified adjusted gross income between $100,000 and $150,000. If a taxpayer has no other passive activities and their rental losses are fully deductible under the special $25,000 allowance, they do not need to file additional forms with their California return to document passive losses. However, they will need to file Form 3801 if either of the following applies. They have other passive activity losses, or they cannot deduct all their losses under the $25,000 exception. California does not conform to the federal rules regarding the rental losses sustained by persons engaged in a real property business, real estate professionals who materially participate. Under federal law, these losses are non-passive and may be deducted in full. Under California law, these are passive losses and are subject to the same rules as outlined in the section on page 21.2. Real estate professionals may deduct up to the $25,000 loss provided they meet all the qualifications to do so and must carry forward any excess and file Form 3801 with their California return. They must also file Form 3801 if they have losses from other passive activities. Substandard housing is property in violation of the California state or local health and safety codes as determined by the city or county regulatory agencies. California law does not allow a taxpayer to deduct certain expenses associated with substandard housing. The deductions for interest, taxes, amortization, and depreciation are disallowed at a rate of 1/12 of each month during the time the regulatory agency determines the property is substandard. There is no comparable federal restriction. Consequently, a taxpayer could deduct expenses on the federal return and then be required to add the expenses back to income on the California return. Let's look at an example. Layla Granger rents out a home on Hogsmeade Avenue. She comes to see you to prepare her taxes. She tells you this past June, the city's building inspector issued a notice of non-compliance because the home was in disrepair. Ms. Granger did not bring the building up to code until November. The building inspector then issued a certificate of compliance. On the federal return, Ms. Granger deducted the following expenses associated with the rental: depreciation, $5,000, property taxes, $6,500, interest, $12,500. What effect will this have on the return that you prepare for her? The home was in non-compliance with the city for a period of 5 months, during which she may not deduct those expenses. The prorated expenses incurred during that period were depreciation, $2,083, property taxes, $2,708, and interest of $5,208. $9,999 must be added back to her California income. A California adjustment is made on Schedule CA 540 as an addition to rental real estate income. Now let's look at depreciation. There may be a difference in rental property depreciation if the following apply. The real property was placed in service between January 1st, 1981 and December 31st, 1986, and between May 13th, 1993 and December 31st, 1996, when California did not conform to federal depreciation methods. The first-year bonus depreciation was claimed when personal property was first placed in service. California does not allow first-year bonus depreciation. If either of these occurs, an adjustment must be made using Form 3885A unless Form 3801 is required. If completing Form 3801, depreciation adjustments are made on that form and not on Form 3885A. Adjustment amounts for rental income are then carried to Schedule CA 540, Part 1, Section B, Line 5. Next, let's look at California's healthcare mandate. California's healthcare mandate began in 2020. Individuals who fail to maintain minimum essential coverage, MEC, for any month will incur an individual shared responsibility penalty unless they claim an exemption. The penalty for not having health insurance is the greater of either 2.5% of the applicable household annual income or a flat dollar amount of $800 per adult and $400 per child. These amounts increase each year. The penalty is calculated on FTB Form 3853, Health Coverage Exemptions, and Individual Shared Responsibility Penalty. There are several exceptions a taxpayer can claim. 3 must be obtained by the marketplace covered California. Taxpayers claiming a coverage exemption granted by the marketplace will need to enter the exemption certificate number, ECN, provided by the marketplace in the space provided in Part 1 on FTB Form 3853. If the marketplace has not processed their application before they file their tax return, complete Part 1 and enter pending in ECN 1 field for each applicable individual with a pending ECN. If a taxpayer qualifies, they may receive financial assistance to help pay the insurance premiums, known as the Premium Assistance Subsidy, PAS. The PAS will need to be reconciled through the tax return. The taxpayer will receive Federal Form 1095A Health Insurance Marketplace Statement and possibly FTB Form 3895 California Health Insurance Marketplace Statement. FTB Form 3849 Premium Assistance Subsidy is used to reconcile the PAS. If the taxpayer paid too much premium, they would receive a refund on their California return. If their annual gross income is higher than the projected income, it's possible they will have to repay their excess premium tax credit. This concludes video review 1. Continue reading and I'll see you back for video review number 2. Thank you for watching.